Okay, so we'll start right in now on our second video. So if you haven't seen the first one, be sure and watch that because this is going to build upon some of the foundational information we provided on the first video. So what we're doing now is we're looking at the day-to-day movement of the market, and we're going to see how intraday the price action tends to react in very clear manner to the different value area highs and lows and points of control that are calculated from the previous day every day. And what we want to do is go through a number of them, so we won't go into the detail of explanation we did on the first video, but we'll get a look at the effectiveness and the consistency of the predictability, the predictive value of these levels in terms of how price action responds during the day. So what you can see is that you have a level and then price action does something in relation to that level. Now, admittedly, sometimes it doesn't appear to do much except go away from it, but even that in itself is very valuable information that this market is very, very strongly inclined to go lower, and that's what it did. And then at some point you have a process in the market that people talk about as the reversion to the mean. So if the market gets too far overextended, in other words, there were so many initiative sellers here, the market kept going down, but at some point buyers come back in and say that's a bargain, so they want to buy it up. And then they take advantage of the afternoon rally up into the close. So let's go them from day to day, and what we see is now the majority of the price action being in this level. This is our value area high, this is our point of control where the maximum value occurred that day, right around this price, and then the value area low, that 70% of the total volume occurred in this area. So the market gaps up, and you would expect that the value area from 2 days earlier would be very strong resistance. It didn't quite make it up there, and that's also a powerful indication. If it doesn't make it to a level, it's probably going to go pretty strongly in the other direction, at least for a while. Or at least you would know that when these bars finish forming, these are 15-minute bars, so this is a complete hour of trading, they couldn't make it back up to that level, then you would certainly expect at the very least they would go down to here, and that's a lot of points. Now we happen to be looking at the Russell here. We can do this with the Russell and the Dow and any contract, but on the Russell, if you go from 514 down to 509, that's $500 per contract. So that's a significant profit right there if you were to act upon that that occurrence of a double top there and sell it with the expectation it would go down here. Now then you can evaluate the response of price to that level, and you can see that it penetrates and it goes inside, and for 3 bars that's 45 minutes here. So what it means is you have 1 hour of price closing below that level, and that really gives us a rule that they talk about in market profile theory, that once you enter a value area, if you stay in there for a half hour, or some people say a half hour, some say you need 2 30-minute closes, but you can certainly get a feeling for it based on the price behavior. And you will see here that they traded under it and they couldn't get back above it after an hour. You have a rule they talk about as the 80% rule, that it is 80% probable it will proceed to the opposite value area, so the value area low. Now in that case you have a distance of 509 to 504.80, so more than $400 per contract in the case of the Russell. So that's another excellent probability trade. And again, different traders are going to trade different ways. These are 15-minute bars. Some people like to take breakouts. Then you know exactly where you could put your stop up here In this case, 507.80 up to 509.40, $160 a contract. It would be your total risk. You go down to smaller time frames, and we'll look at these things in more detail, and you might see a 1 minute or 3 minute pattern forming here. Maybe the stochastic is perfect double top or divergence on a 1 minute or a tick chart or whatever. There's just so many ways, but once you see it break here, you want to do something to participate in this move. Ideally, in a situation where you're gapping up from the value area and then you're going nowhere and you're not reaching the prior day's value area, you really want to get short somewhere up here and then evaluate whether you want to stay in the trade by whether it bounces strongly off the value area when it gets there. In this case, it went straight through it and then stayed under it. So those people would have a reason to hold at the very least part of their position to go for the huge profit on the way all the way to the opposite value area. Now in this case it proceeded and it penetrated strongly through convincingly, and that would now be resistance. So later in the day when it got up there, it was rejected from that value area low. So a lot of information and a lot of trading opportunities can be derived strictly from the value areas themselves, trading off of these levels, but we're going to combine that with a lot of other information or strategies and tactics that we can use, different time frames, indicators, whatever. So the next day the value area low was lower, the point of control was lower, but this is an interesting, this isn't too common, but sometimes it happens, that because you had enough volume trading here in the morning, they gave it a real shot to try to recover from that penetration to lower value. So there was enough volume there to put this entire spread in the 70% portion of the entire day's trading. So you have a value area high way up here, and that actually, when you consider the reversion to the mean theory, would be a good reason to expect when you're down here that you're really stretched, and that they may want to go up and at least try again at the point of control. Because what happened on the open is they were rejected right at the point of control. That's powerful information there to expect trading to the lower value area. They didn't hold there at all, penetrated strongly, but they re-entered the value area. And this is very significant. That in itself is another powerful predictor. Once they break through a value area, the question is, does the market have the will of the participants, the energy to continue to go to, say, some prior historical value area, or to set new lows or whatever? And if it is rejected in this manner, in this case it took them 20 to 30 minutes, but once they immediately spring back into the value area, that's saying that the market is in that behavior typical of reversion to the mean. So the reversion to the mean, typically moving averages are a good indicator of that, and that you'll expect it to go there, or the point of control is the first one. And then we can also look at the pivot levels. So in this case, when we apply the pivot, which was right here, and oops, I'm sorry, we go forward a little bit. So here was the pivot for the day. That's the first expectation. They're breaking the value area low there. They're going to go up to the, breaking back into it, they're going to go back to the pivot and see what happens. And then if they get through the pivot, which they did, then the next target will be the value area high. So this is what happened on this day. They followed that very normal behavior. And we're going to stop the video here and continue in part 2. So don't go away, come back and listen to part 2.